If you are currently going through the cycle of buying evals, blowing them, maybe you pass one here and there, but for the most part, you're buying evals, blowing them, and all you hear on social media is just keep buying accounts, don't quit. One day you're going to make it. If that's you, you clicked on the right video. I'm going to be giving you some actual tips and things you can implement into your trading to start progressing today. If this is the first time you're watching me, my name's Nolan. I'm a profitable day trader with about $20,000 in payouts. And trust me, I have been in the exact same position you are. You know, I hear everyone online saying, whatever you do, don't quit. Just keep going, keep going, keep going. And at some point, you just look back and you see all the accounts you've blown and you're wondering, like, when is it going to start getting better? I have been there, trust me. And when I was there, I wish I would have found a video like this to help me out. So that is exactly why I'm making this video. In today's video, I'm going to be giving you 5 tips that you can do today to start improving your win rate and improving your trading. So, number 1, you need to stop bringing external factors into trading. Think about it logically. The market doesn't care how you feel that morning. The market doesn't care where you think it's going to go. Regardless of what you think or any external factor, the market is going to do what it wants. So you should start thinking like that. If at any point when you're about to take a trade or you're looking for a setup in general, if you have to ask yourself, why am I taking this? And the answer is anything external, you should not be taking the setup. Meaning, I think it's going to go up because discretionally, I've seen this play out before. Or I think if you ever like hear yourself saying, I think, I believe, just stop for a sec, because majority of the time you should not be taking that setup. I know you always hear these experienced traders online, like Dodgy or whatever, showing his trade of the day, saying, oh, I took this, a lot of it was discretion. That doesn't matter. You do not have to do that. There is more than enough A+ setups in a month that you can take, that you can be 100% confident on without any external factors. Anytime you're going into a trade, you should ask yourself, has the market shown enough confluence for me to infer that price is going to go in either direction? If that answer is no, and the reason you're taking a trade is because you think or your discretion, do not take the setup. Now, something I do want to mention is that obviously discretion is a huge part of trading, but it should come after the trade is already mechanically A+, or whatever trade setup you're taking. Because obviously there are A+ setups that are going to be winners and there are A+ setups that are going to be losers, and sometimes the only thing that causes you to take one and not take the other is discretion. So yes, obviously, as you become a more experienced trader, you will just naturally build this discretion that will cause you to stay away from some losses. However, discretion is not a confluence. You should not use it ever to bump a B setup to an A+ setup. Tip number 2, getting into a little bit more actual mechanical tips and things you can use on the charts to increase that win rate. So PO3 is key. So let me explain what this means on the charts. So I'm sure most of you know what PO3 is. If you don't, I'm going to go over it super quickly. PO3, or the power of 3, is the same thing as an AMD, is accumulation, manipulation, and distribution. So what that would look like is accumulation, manipulation, distribution. So we have a accumulation phase. I'm just going to go over this like super quick. We have accumulation, we have a manipulation leg. So we sweep out all these generated lows, and then we get distribution, and you would take something like this, bang. And vice versa as well for shorts, and you would take something like this. I promise you, if you look for the PO3 or AMD and you only take setups that have a clear AMD, your win rate will skyrocket. And that brings me on to my next tip, or third tip, is you should be trading time. Let me explain. So, what do I mean by trading time? So, first thing to understand, which I'm sure most of you do, is that time frames are fractal. So, for example, one 4-hour candle is really scaled down, 4 1-hour candles, 16 15-minute candles, etc., etc. So the strongest AMD models or PO3 setups are ones that happen in line with the 4-hour candle. So what does that mean? Scaling down, let's go to the 5-minute. Okay, so we have 4 hours marked out. The 10 a.m. open, and then it closes. That 4-hour candle would close at 1. Now, I like to use the 4-hour candle because that is what a lot of traders refer to as the 4-hour PO3 or the 4-hour AMD, and I'll show you how to use that now. So let's say 10 a.m. opens. Now, what that means is the previous 4-hour candle closed and a new one has opened. So what we can look for within this kind of span of time is if you see an AMD setup generating during this, it holds a lot more confluence because it aligns with the 4-hour candle. So for example, 10 a.m. opens, we have a new 4-hour candle. In the first hour, we see accumulation. Then within the next hour, we see a manipulation leg. Then the third hour of the 4-hour candle, we see distribution. So you can use this to your advantage when looking for a AMD model. See if it aligns with the 4-hour candle, and it adds a lot of confluence. The same thing goes for the 10 a.m. reversal, if you've heard that before. So if price is moving in a certain direction at 9:45 New York time, and there's a draw, let's say price is moving higher, we're making higher highs, higher lows at 9:45, and you are expecting some sort of reversal for whatever reason. Let's say there's a new week opening gap right here, and you want to see price move towards this. Trading time, you would wait for the 10 a.m. open before taking some sort of reversal setup. Why? Because 10 a.m. is the open of the new 4-hour candle, and a lot of the times that will create the reversal as well as other confluences. A lot of the times this actually lines up, and you sometimes don't even have to think about it, but it is good to keep this in mind if you're looking for a setup. What time is it? When is the 4-hour candle closing? Did a 4-hour candle just open? You could also call these stacked PO3s. Same with 9:30. Do we have a 9:30 PO3, a 10 a.m. PO3? All these things are things you should be looking at when looking at setups. You should be so aware of the time, what time it is. All these things you should be kind of aware of because they all play a super big part that you might not even realize. So I don't know if I explained that super well, but the key takeaway from that is you want to be looking for AMDs or PO3s that are stacked with certain times. For example, 9:30, which would be market open, 10 a.m., which is a 9:30 a.m. macro, as well as a opening 4-hour candle. All these things you want to be in the back of your mind when taking setups. If you only take setups within, certain macros or certain 4-hour candles opening, your win rate will 100% increase. If you just think about it logically, if you only take reversals at 10 a.m. versus if you take a reversal at random times of the day, the ones you take at 10 a.m. will have a lot higher win rate because of that 4-hour candle and just because of the 10 a.m. reversal in general. So moving on from that, tip number 4. So for DOLs, this is something that you can kind of add to your DOLs, and I'm not going to say you should only target these, but if you focus on these, you will 100% increase your win rates. And those DOLs would be high time frame LRL and high time frame unmitigated gaps. Trendline liquidity, and you should be targeting high time frame trendline liquidity. So for example, even today, I had this marked out as DOLs, and you can see we just absolutely plowed through it. So what is LRL? It is, for example, if we are on a downtrend and then we see some sort of, reversal here, all these generated highs, so these swing highs that fail to sweep each other, are LRL / generated liquidity. And if you target high time frame LRL, it's commonly a very, very strong draw on liquidity. For example, even today, this is 1 hour LRL, or even like 4 hour, and we just absolutely ran straight through it. Obviously, there's tons of examples. So LRL, or trendline liquidity, is not a difficult thing to kind of grasp, but just add it to your notebook. Target high time frame LRL, use it as drawn liquidity, and it's a very strong drawn liquidity. Same with high time frame unfilled gaps. So I would consider 1 hour, 4 hour, daily, or weekly high time frame. Target these as drawn liquidities. For example, you can even see right here, when price was up here, we have this unfilled 1 hour fair value gap. If you want to scale down, obviously, and then use this as a drawn liquidity. Obviously, this isn't actually a setup, this is lunch, but if you wanted to target this as a drawn liquidity, you could have, for example, taken this 1 minute and targeted this unfilled 1 hour. So use high time frame LRL and high time frame unfilled gaps as draws on liquidity. For the fifth and final, or is that six? I don't know. For the fifth and final tip, this is the biggest thing that I see in beginners that just causes them to continuously blow accounts and continuously lose, is the inability to step away from the charts. Not only after taking a loss, even during a session, if you recognize price action is not the best, if you recognize maybe you don't like a setup, step away. You aren't going to lose anything if you step away, or if you already have taken a loss, it can't get any worse if you step away from the charts. I know this might be obvious, and I know you might know this, but I know a lot of you still continue to do it even after you know it, because I was in the exact same scenario. Think of it in the most long-term way possible. If you are constantly, think of it like a chart. Think of this as your win rate chart. You have one good week, boom. Then the next week, Monday, Tuesday, you take a loss. Then the next couple days, you win again, boom, 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 boom. And the only way that this increases continuously is if you are able to walk away after these losses. If you are winning, then you take a loss, then you spiral and go down, boom. Then it's literally the opposite. Then you have some winning days, then you take a loss, then you spiral, boom, boom, boom. Now all of a sudden your bank account P&L is in a downtrend. And believe me, I know how hard it is to flip the switch in your brain to just be able to get off. It's extremely difficult, but you have to understand that is the only way that you're going to progress in trading, is if you walk away from those losses, and if you walk away after taking a loss. You always hear people on social media saying, don't stop, don't give up. If you keep going, you will succeed. I promise you, if you don't learn to walk away from the charts, you will never succeed with trading. You have to learn when to walk away, or else you will blow weeks of progress in a single session, and it is never worth it. But that pretty much is all I have for this video. I hope you guys enjoyed it. I hope you guys could gain something from it. If it's your first time watching one of my videos, make sure to hit the subscribe button. Make sure to join the Discord below. It's completely free, obviously. We just use it to connect, share some wins, share some progress. And yeah, drop this video a like if you learned anything. Thank you guys for watching, and I'll see you in the next one.